Alright, it's time for another walkthrough of the weekly S&P 500 chart storm. And this week, as you can see there, I've described it as a good mix of charts on investor sentiment, valuation, cash allocations, correlations, and sustainability. So we'll get straight into it. And we're starting off this week with the Euphoria meter. And this is a combination of the forward PE ratio, bullish surveyed sentiment, and the VIX. So it's given you a well-rounded view of sentiment by looking at market measures and surveyed measures. Bottom line is, it has dropped off from very frothy, very euphoric levels down to slightly less euphoric levels. Basically that froth has been taken out of the market there. And on a very similar note here, we've got the TD Ameritrade IMX, which is the Investor Movement Index. Got the link there if you wanted to check that out. Now this one, it had gotten to indeed very extreme levels, and it hasn't got the years shown on this chart, but September, March, it goes back to, I think it's about 2010. But anyway, you've had this substantial run up here and an even more substantial reset. So it's actually on this particular index is back to levels that we're seeing, around the 2015-16 corrections. So it's quite interesting really just to see how much that one has moved in particular. And then if we take another look at sentiment, we've got here from Sentiment Trader, very worthwhile following these guys, very interesting and professional analysis. So this one is the AAII, American Association of Individual Investors, bull-bear ratio, and you can see there that it's moved from extreme optimism to now extreme pessimism, which quite extraordinary really how far that's moved. If we look at this little table below, which gives you a little bit of backtest statistics, shows that generally coming out of this condition, oftentimes, not all the time, but most times have a pretty good experience. So if you look at, whether it's the Euphoria meter dropping off only somewhat, and the IMX dropping off substantially, and the bull-bear ratio flipping right around, it's a very interesting sentiment setup there. It's very tempting to call the end of the correction with these types of conditions. Certainly raises the odds. Looking into another couple of interesting charts which kind of speak to similar kind of things. First one here, and it is from a week and a half ago, so slightly out of date, but still broadly the same. You got the forward P ratio in the light blue. You can see there that it's at least at that time, so it's into the low 16s from the high 19s, or from the 19s rather. So that is a decent pullback really, and certainly cheaper than it was throughout most of last year. And then the other interesting thing which is on this chart is this green line, which is the number of rate hikes that the market is pricing in. The reason that's interesting is because, if the market's sitting there thinking, yep, we haven't really changed our view on how many times the Fed's going to hike rates, then that's basically another way of saying that, we haven't changed our view on the macro backdrop, and it really, a lot of it does come down to that macro earnings backdrop, which still remains pretty decent. And if you have, a reset in valuations, a reset in sentiment, and the macro backdrop still the same, it looks like a pretty good setup. One cautionary to that, or one way to temper that, is to look at the median price to earnings ratio, which Ned Davis research here have calculated. One thing I would note about this one is that it's based on trailing earnings, and You know, if you look at forward earnings, the argument is that there's been a substantial uplift, or there should be a substantial uplift from the tax cuts, as well as, you know, a couple of trends that are already sort of baked in terms of, you know, like the weaker US dollar, better commodity prices, and just better global and domestic economy. So, you know, you could argue that this is perhaps overstating the extent to which it's overvalued. Moving on, this one shows you in the red line implied cash allocations, and that's based on the ICI data. So it's the amount of money in money market mutual funds divided by total mutual fund assets under management. So it gives you kind of an implied view, and sure enough, it actually lines up with the AAII survey of investor allocations. Either way you look at it, and we actually had one on this actually in the last week, which was from Charles Schwab, showed the cash allocations of investors there, and it's the same picture. It's you know, cash allocations are at a cycle low, in some cases a record low, and you know, one way to interpret that is that investors are fairly fully invested. You know, at 15% here, which is, you know, around 15-20% cash allocation, it's still, you know, far from zero. So, you know, technically you could make the argument that, you know, they could get a little bit more fully invested, technically. I did talk about this chart in a little bit more detail alongside broader asset market valuations. If you click the link there, or if you look on the YouTube channel, you'll see it talk on the global risk radar, which definitely worth looking at if you're thinking about, you know, the outlook for markets and economies at this point. Anyway, moving on. Number 7 here, shared by Tiho. It's a really cool looking chart, this one actually. It's a change in average stock correlations, and you can see there that it spiked 87, 08, 11, and again this year. What do these times have in common? It's panic sell-offs, you know, rapid corrections in price, and you know, it's pretty logical that you see correlations spike in this kind of conditions, because you know, investors just sell everything as they go to raise cash, and you know, especially when you've got things like increased passive exposure. When investors are selling passive exposure, then you know, it's more indiscriminate selling. Anyway, that one would be, you know, adding to the picture that perhaps the buy signals are starting to align, or at least there's more and more signals which could be interpreted as buy signals. And number 8, one by own, this is the CBOE Implied Correlation Index. Now, just a side note, the red line here is the Implied Correlation Index. It is flipped upside down because it seems to have this contrarian signal. The other thing is that it is a continuous series, so it's an analytical series which I've designed, or you know, integrated the signal from the various vintages, because the Implied Correlation Index, you have, it cycles between 3 different indexes. They each only stay in force for about a year or so. So you just have, that's just one side note on how to use that data set. In terms of how to interpret it, the way I tend to think about this is that periods of low correlation tend to see, you know, particularly low correlation tend to see higher risk of a correction, and periods where correlations spike tend to see, you know, raised odds of market bottom, or you know, better performance ahead. And it's not so much the absolute level, but the you know, the where it's at compared to where it was. You know, almost a rate of change type of signal. And yeah, I guess the logic for that is that, fairly similar to that previous chart. You know, when correlations spike, typically that's when bad things are happening, and you know, markets tend to bottom at a more rapid pace than they do top. Number 9, fear of missing out. Interesting. Let's put, you know, maybe if you have a fear of missing out, you should consider this chart. If you miss the 10 best days of the market between this period, your return, the longer term return, would be almost half. So pretty interesting chart there. And the final one, just a bit of a food for thought chart, shows the adoption of sustainability reporting across companies in the S&P 500. Pretty interesting how rapid the uptake was. You know, only about 20% of companies were doing it back in 2011. Now, you know, the majority is 85%. And, you know, I guess it speaks to the increasing popularity of ESG investing, and, you know, it's ESG investing's pretty well proven at this point. You know, yeah, there's the sort of I guess the feel-good factor about it. You know, that you feel like you're doing a good thing, but more to the point, there's just the point that, you know, by taking a broader look, a broader view, thinking about those ESG factors, you raise the odds of excluding the companies which are, you know, at risk of legal liability, at risk of brand impairment, or, you know, at risk of general backlash, as you know, the spotlight inevitably gets shone on the ones that are doing the wrong thing. You know, it's like in life in general, if you do the right thing for long enough, you'll get recognized for it, and if you do the wrong thing for long enough, you'll face the consequences. But anyway, that's a sort of final thought, or final interesting kind of chart to round this one out. In terms of market views, you know, if correlation spiking tends to be a buy signal. You know, I mean, these two, the cash allocations at low levels, trailing P at high levels, those are late cycle signals, there's no doubt about that. But, you know, you throw in the fact that forward P's a reset, sentiment's reset, and correlation's spiking, maybe the odds of end to this correction are rising, you know. So it's something to think about. If you've got any comments, questions, want to let me know your own interpretation, go ahead and put them into the comment section of the video, and be sure to subscribe to the channel so you don't miss out on any future updates. That fear of missing out again, don't miss out.